Hi, welcome back to the channel. Today we're going to be talking about critical illness insurance. But before you turn the video off, because I know it's not everybody's favorite topic, I think this one's actually pretty interesting. Recently, Canada Life sent out a report to a number of advisors, myself included, with real statistics and real examples of critical illness policies that paid out last year in 2023. I think it's quite interesting. We're going to look at a few different examples. I'll also run quotes as if those were policies being put in place today, and we can compare how much out-of-pocket money these people probably spent and how much they actually got in their benefits. So let's get started. So this is the report we got from Canada Life, and it's a look at living benefits claims. So I'm going to scroll down here because the first thing that really made me interested in reading this report is this figure here. Canada Life alone, remember this is just Canada Life, so this does not include Manulife or Empire Life or all the different insurance companies across Canada. Alone, Canada Life paid out $61 million last year in critical illness claims. And in case you're not 100% sure what critical illness insurance is, it's something that I believe is becoming the most important type of insurance for a financial plan. I believe it's been doing that over the last number of years. Life insurance is relatively simple to understand. If you pass away, it pays out. Disability insurance is also relatively easy to understand. If you're disabled, it pays out. Critical illness is kind of in between the two, and there's actually very little overlap between disability and critical illness. And it's meant to pay out if you become critically ill, but survive. If you survive 30 days with a critical illness, like a heart attack or stroke or cancer or something like that, you are paid out a lump sum. It is not a reimbursement of medical expenses. It is a lump sum for you to use as you see fit. And the reason I use heart attack, stroke, or cancer as my examples is because those three represent 81% of all claims from last year. And they actually have a breakdown of that here as well. So 67% of all claims that were paid out last year were cancer related, 12% were heart attack related, 2% were stroke related, and 19% were other. So that's why when I talk to clients about this, I always just talk about these three because statistically they're the most significant. From here, Canada Life actually included a number of examples of real cases here, which I've never seen them do before. And I thought it was really, really neat. So it's organized in terms of how many years the policy was in force. And so what I did, and what we're going to jump into in a second, is I picked three cases at random. A very, very short case, like it's only been in force for a couple of years. This one, a 44-year-old male that had the policy in force for 2 years, got cancer, received $100,000. I picked one that had been medium. So here's a 72-year-old female. Policy had been in place for 17 years. She developed cancer, received $50,000. And I picked one that's been here for a very long time, a 66-year-old male, 22 years of enforced policy, developed Parkinson's disease, and received $25,000. So I'm going to jump to a spreadsheet here. We can dive into these policies a little bit deeper. So here's the quotes as if these policies were all starting today. So just a reminder for the first example, it was a 44-year-old male that had the policy in place for 2 years, meaning that if this was starting today, I'm quoting based on a 42-year-old male. The female was 72. It had been in place for 17 years, meaning she's 55 for the quote. And the last male is 44 because it's been in place for 22 years and he's currently 66 years old. And what I don't know is I don't know how these policies were actually structured. I also know that pricing 22 years ago was probably very different with Canada Life. So there's a couple asterisks here, but this is if they were starting the policy today. A very, very basic policy for $100,000 for a 42-year-old male, assuming average health and a non-smoker, would be $48 a month, and a fully loaded policy would be about $175 a month. Now, what fully loaded means is that the premium is static all the way to age 75. And if this person happened to not use the policy, all of the premiums would be actually returned to him with no growth on his 75th birthday. For the female, the range is $70 to $231, and for the final male is $17 to $56 per month. And again, here's how many years it was enforced. From here, I want to take a look at how much they would actually have been out of pocket compared to the benefit that they received. So that's on the next tab. So taking all of these ranges into consideration, we can see just how effective of a use of money all of these policies were. And of course, in the world of insurance, if you only had the policy in place for a year or two, you're obviously going to get your most bang for your buck. And in this case, the 42-year-old with the range of $48 to $175 per month is out of pocket somewhere between $1,100 and $4,000 overall over the 2 years, and they're going to receive a $100,000 benefit. That is obviously, financially speaking, and strictly financially speaking, that is obviously a great use of money. Obviously, it's not great that this gentleman developed cancer and a critical form of cancer and is receiving this benefit. But strictly financially speaking, that is an absolutely fabulous use of money to go somewhere between $1,100 and $4,200 a month to get $100,000. In the case of the female, this is where it gets really, really interesting. In the really basic policy, she's probably out of pocket around $14,000, but in the loaded version, she's out of pocket around $47,000, and it's a $50,000 benefit. Now, what's important to note here is, again, after 20 years, when she turns 75, if this was a loaded policy, she'd be getting every dollar that she put into the policy back with no growth. So it makes sense that this number is so close to 50,000 because that's how the insurance company would have designed it in the first place. So here, if this is what she did and she's getting the 50,000, obviously it's not a fabulous investment, but if she did a little bit more of a basic one, it's still a great use of money. And in the final example, again, somewhere between $4,000 and $14,000 and receiving $25,000 of benefits, probably a pretty good use of money. But more specifically, it is a great example of these three clients and all the other ones that were shown on that graph of shifting risk. What I mean by shifting risk is that you are taking a set dollar figure, let's call it $50 a month, and you're assigning it to Canada Life with the expectation and contract saying that if I become sick, you are paying me. They're taking that risk on. In the case of that, I no longer have the risk of being financially burdened if I happen to have a heart attack, stroke, or cancer, or at least not as much. So for lots of you watching, you're probably close to retirement. This may not apply to you right now, but for those that are a little bit younger, maybe your kids or people that you know, if it's time to look at opportunities to shift risk away from yourself and to different companies, there'll be a link in the description down below that'll come directly to me. I'd be happy to help. Till next time, keep planning.